Because when you're about to speak, do introduce yourself and let us know how you'd like to take your POIs. In terms of time, I will not keep timestamps in the text space. I will, however, interrupt you when your speech is supposed to end at 7 minutes, 15 seconds. If there is no other issue, we'll now call on the Prime Minister to begin the debate for us. Here.
I'm audible, right? Yeah.
Loud and clear.
Awesome. I want to be very clear from the get-go as to what this motion is about. There are two kinds of accounts based on this debate. We'll have equity accounts and non-equity accounts. What happens with regards to equity accounts is when people go and invest in them, or they go and put money into them, you have to go and buy government bonds based on that same amount with regards to like government bonds, and you have to buy those based on that, right? And with regards to non-equity accounts, you don't have to do that, and you have the ability to go and invest. The opposite. You, with regards to equity accounts, you have to go and invest in things. With regards to non-equity accounts, you have to go and buy government accounts. So you have those two specific accounts, and that is how the motion is going to work. The first thing I'm going to prove is that crisis is incredibly likely because of a multiplicity of reasons, and reducing crisis is the most important thing. And we give governments more money to actually reduce crisis. Why is crisis very likely? The first thing is there's a multiple degree, like amounts of exogenous shocks that can happen to the economy. So this is things like COVID. This is things like the war in Ukraine. The things you can't actually. Yeah, actually, go ahead. Yeah.
Will deposit insurance apply to the equity account?
Yeah, that's fine. The thing with regards to crisis. So I think these are very likely because of things like exogenous shocks. This happen because of like things you can't really control based on the fact that like you have oil crises, you have wars that are happening in status quo. You can't really control those things. The second thing is I think economies are inherently like cyclical, right? Like they have downturns, they have like upwards trends. This happens outside of the control of most governments, and you can't really like ensure that those downturns don't happen. But the third thing is like most investors in like investing things or like banks have like very pernicious incentives to go and profit as much as they want to. Then this means that they go and invest in really problematic things and invest in very risky investments. These risky investments don't give the same amount of profit, or like don't have the same security as many other things. Hence, they're likely to like fucking fail. When it does fail, like you can have like banking crisis that exists. You can have like mortgage crisis with regards to things like what happened in 2008. This means crisis is likely. It is incredibly hard to prevent crisis because it happens because of things sometimes out of your control. The first thing I'm going to posit is that governments are better suited to deal with crisis. The intuition here is very simple. When you go and deposit money, that money will now have to be bought with regards to government bonds. This means that money now goes to the government, and the government has that money to utilize in any way it wants to, and like utilize in the actions it wants to. The first thing that I want to prove that means is that when crises do happen, governments are better suited to respond to them because they have a larger pool of money to actually utilize in their response. This is like very intuitive, right? So the thing is like when you have a great amount of money, they have more flexibility and more like resources to actually go and respond to that crisis. And I think governments are very well suited to do this response because of like the fact that they are like advised by technocrats, because they have like good incentives to like get elected again, and because they want to like reduce reduce harms that happen due to like economic crisis, like unemployment, like poverty that happens because of those reasons, right? That means that governments are well suited to do this, and they have the ability and the good incentives to actually carry it out. How would this actually materialize? This would mean that the government has more money to go and invest in like areas that they can stimulate the economy better, because if you feel like one sphere of the economy will be better stimulated by using this like increased amount of resources, they can go and do that, reducing the impacts and reducing the effect, the pernicious effect of the crisis that is happening, meaning that it reduces the harm that happens to the people on the ground as well, right? But the second thing is that this means that the government also has money to go and bail out other banks that are important for the system to exist. Important for like if bank is like essential for the system to like the banking system and the economy to exist, the government now has more money to go and provide bailouts for those banks and reducing the harms that happens when those banks collapse, right? I mean, the like weighing here is very simple. Economic crisis is what's most harmful for most people on the ground, right? Because it's like every single person is like dependent on the sustenance of the economy for every other aspect of their lives. This means if we can prove, even to some degree, they're able to solve and deal with economic crisis better, I think this in of itself is an incredibly important thing. But the second thing I want to posit is now banks take less risks with regards to how they go and invest money in the first place, right? The intuition here is very simple. One of the big reasons as to why like banks take like mass amount of risks with regards to how they give loans and how they give their like money money away is because they have such a big pool of money and they don't really big pool of money, but also because of the fact that when they make risky investments, the likelihood that they get profit and return is also like higher. So they are most likely pushed to make the most riskiest investments because they want to get the most risk, like most amount of profitability, right? And this is like the intuition why they're backed by this is like very simple. They want to like please the investors. They want to make as money as they can because that's like how the biggest motivation that backs them. That is what pushes them to make action, right? The change that happens in status quo right now is the amount of money banks have to make those risky investments reduces. This changes the incentive structure for banks and reduces that capacity to make the most risky investments, because the most risky investments are most likely going to be the largest as well, right? Because you have to put most amount of money in there. But two, like you are less likely to do that and choose the safer investments now because you know you don't have the same pool of resources to actually fuck around with, right? And I think the impact of this is very simple. Now you make more investments in safer, safer places which which aren't likely going to like fuck the economy up and like fail. Hence, you reduce the likelihood of crisis happening based on like risky investments in the first place. That also change the incentive structure of the banks. I think this is like incredibly important thing that happens, right? Like banks using bad incentives to like fail the economy has had pernicious impacts for everyone in society to a large degree. I think changes this incentive in itself is a good thing. Before I go on to the last thing with regards to confidence, I'll take you.
Banks in your world won't be able to use the majority of non-equity accounts to raise any sort of significant finance or profitability. Aren't they likely to use the money in equity accounts in risky investments to try to get some sort of high yield out of them?
Not really, right? Like why would they do that? Because like if they use a small amount of money and they like it's so risky and they won't get it in and they're completely fucked. It's more likely it's better to make safe investments, and like stability of the banking, like the bank itself is also important because you don't want to fuck over investors, and that is the most likely manifestation of this incentive. The final thing that I want to talk about is with regards to confidence. I think more investors and individuals on the ground itself are going to be more confident with the banking sector. The intuition here is very simple because comparatively government bonds are incredibly stable. This is because the government has reserves to back them up, because there's a legal obligation to give back, legal obligation to give back when you buy a bond, you have legal obligation to pay back the money that you bought it with, right? All these reasons mean that government bonds are incredibly stable. And now when you go and the banks go and invest in government bonds, that stability also diffuses into the banking sector as well. The reason why this is important is I think confidence is the prerequisite for investment going in the first place. This means foreign investors won't go and invest their assets in these countries if they feel like there is no stability, if they feel like there's no confidence in the economy. Comparatively, we get more confidence. I think we deal with crisis better. We also reduce the risks of economies and banks making bad decisions. All of these reasons, Ujis.
Thank you for that speech. We'll now call on the leader of the opposition.
Moment. What we needed from opening government was a much clearer conception of the way that the model in this debate works. Because what this debate does is it gives consumers who are putting their money into banks a choice. On the one hand, it allows them to put their money into a narrow account, and that's the account where the bank essentially can do nothing with it but buy very low interest government bonds. And the second thing it can do is put it into the equity account, which is the place where the bank can use those deposits for loans and investments. The reason why you would choose to put your money in the equity account instead of choosing to put your money in the safe, narrow account is that in that equity account, the bank will pay you more interest. The reason why is that it wants you to put your money into that account because it can use that money to lend out or invest and make money and make returns that are much higher than what they can make from your narrow account. Government concedes this. The problem with the answer to the POI, and I would really encourage them to change their answer in deputy so that the debate actually has any margin at all, is that if the government applies deposit insurance to the equity account, so to the riskier account, then everyone will put their money into the equity account. Narrow banking in the way that it's been drawn up by economists and policy experts always involves the exclusion of deposit insurance from the equity account, because otherwise everyone puts their money into the risky unbound account and the government guarantees it. It says that if the bank goes under, we'll guarantee the money that you have up to a very high amount, higher than most individual people actually have in the bank. So they want an impact. They have to have people putting the money into the narrow account, not the equity account. They can't use the government to subsidize risk. The impact of their case is literally nil unless they take away the deposit insurance. If they change their answer in deputy, we won't tell anyone. So they're more than welcome to do that. Now let's get into the actual case. I have one broad response to their framing before I get into our argument. During a crisis, government should spend money on fiscal stimulus, quantitative easing. This is how the US successfully got itself out of COVID, by handing people checks that they use to reinvest their money, to pay off their debts, etc. Raising money is what they're going to do on Gov, because during a crisis, people are going to take their money out of risky assets like stocks and park it into their bank accounts where it's safe. Then banks in Gov's world are mandated to use the money that people put into their bank accounts to buy government bonds. The problem is that when banks raise a lot of money, when governments raise a lot of money from bonds, from selling those bonds to banks who are in turn using it to back the deposits, that crowds out private investment. Because the consequence is that investors, in this case banks, are putting their money and giving it to the government instead of giving them to private enterprise, instead of giving them to people. And to recover from an economic crisis, what you don't want to do is have everyone hand their money to the government. What you want to do is have them hand their money to businesses and people to get the economy going again. And so they actually create the exact wrong response here. On to our case. There are three arguments. Number one, their side reduces credit availability. Number two, it leads to higher banking fees and costs and reduced banking access. And third, it leads to the rise of shadow banking. Tejas will expand on this. First, on credit availability. Now, I want to be very clear on why growth is more important than stability to begin with, because the thesis of this argument is just that more people are going to have availability to credit, access to loans, and so on. There are a couple of reasons. First, governments on both sides have significant ability to respond to economic crisis. They can print money, they can give people checks, they can use welfare services, etc. And so the downside caused by economic crisis is handled with short-term costs by governments. The second thing is that crises, when they happen, are bad, but they are rare, right? 2008 was the worst crisis of modern economic history, with a huge set of regulations, by the way, that helped to reduce risk after 2008. There were raised reserve ratios, so we already got parts of Gov's policy to a larger extent than we already had before. There was increased stress testing, and we can use fiat, by the way, to expand some of that stress testing. And if you wanted to raise reserve ratios by 1 or 2%, you could. You know, the central bank could react to changing economic conditions and deleverage risk that way. So there was a lot of de-risking to begin with. And those crises end up being rare, but growth is constant. Growth creates the prerequisite to have cash buffers. Growth is what creates tax revenues for governments. Growth is what allows people to feel secure in their personal finances and therefore deposit money into banks. And the whole stability of the banking system is dependent on growth, much more than growth is dependent on stability. The reason why is that growth is what gives money to banks. It gives them a capital buffer. Banks that are at risk of going under are ones that are suffering from low economic growth, meaning that depositors are putting less money into the bank, and therefore the bank has less money to cover its own costs. Why will this motion decrease credit availability? Well, first, Gov must concede this for their case to work, and I think they do. But most obviously, the bank is now, as long as they take away the deposit insurance and Gov does the proper model, going to have less money available to lend out to other people, because it has to take all its deposits and put them into government bonds and back them up directly. The consequence of that is that is money not going to small businesses, not going to students to pay for their education, not going to people to buy homes. And of course, not all debt is good. Some debt is bad. That's why we have credit regs. That's why we have regulations to ensure responsible debt use and repayment. But it is incredibly important for economic growth that businesses be able to grow and expand, that individuals be able to upskill by affording education, that people be able to buy homes with money that they don't have yet, as a means to make their lives significantly materially better in the short term. And so the availability of that credit will all decrease by a very, very significant margin on their side. Take the POI, yes.
So just to be very clear, once the government gets billions of dollars through the buying of these bonds, what do they do with the money, you think?
Yeah, I mean, I guess they will, yes, of course, use some of it on stimulus during the economic crisis. But the money that they're getting is much smoother, right? Like they're not getting huge inflows of money during crisis because you're reducing the overall movement of the economy. And stimulus is not the end; it's a means to an end, right? Like the reason why it matters that the U.S. government had money during the COVID pandemic wasn't to hoard it; it was to give it to people so they'd spend. You are just creating an intermediary second step. Money's flowing to the government, then it's the government's job to effectively redistribute it back to people. Will they always do that well, effectively, fast enough, etc., and then move along? We just keep the money in the economy. Second, on the increased cost of banking, and I want to be very clear, there are lots of people in the world who pay very high fees for banking or who are unbanked, especially in the developing world. You have to be encouraged to put your money into the bank. And one of the most critical reasons for that is the fact that you are paid interest. This motion will vastly decrease the amount of money that banks make. They just can't pay you high interest if they can't do things with that money that earn them more money than the interest that they're paying to you. But second, they're just less profitable. And the consequence of that is that the fees that everyday people use to pay for banking, like just the fee to open a checking account, the fee to open a credit card, overdraft fees when your account goes under, financial flexibility that banks can offer to younger clients to help ease them in when they don't have as much money. All of those are things that go out the window. Banks don't pass those costs on. And I partially agree with CEO here, by the way. They will do some risky lending with equity accounts that will be unprotected by deposit insurance. But everyday people will suffer from the fact that banking becomes vastly more expensive, both the people who want to lend money from banks and the people who are putting money into banks. For all those reasons, very proud to oppose.
Hi, can you hear me? I don't know if that's a yes.
Thank you for that speech.
Ruth, you lagged for me, so I don't know if it's my internet.
It's lagging for me too.
She dropped, right?
I think we'll just wait a few moments until she
sounds good.
reconnects.
Hi, Manuel. I can hear you now. I just got disconnected. I'm back now.
Sorry, I couldn't hear that. Could you say that again?
Back now, so you can speak. I got disconnected for a second.
Oh, sounds good. Can you hear me? Okay.
Yes, I can hear you loud and clear.
Okay, cool. Okay. Okay. After the Great Depression in the 30s, a mass of economists and intellectuals demanded narrow banking, and the same happened after 2008 because they noted that there were a couple of issues. The government does ensure that like a certain amount of money is insured if there is a bank run, but there are a couple of things that they cannot cover for. The first thing that we would note is that sometimes there is more money that you need to bail out for than there is insured, i.e. the government will only like pay you back 100 million in case 100 million are lost, but nothing beyond that. And when it's a crisis that involves like the global supply chain or something like COVID or the 2008 financial crisis, more often than not, the amounts of money are way bigger than just 100 million or however much the government had promised to give you back. And so in many instances, this means that you do not have the capacity of recovering from these crises. In very average, reasonable voter language, this means that the government says, like, give certainty to investors, average people, companies, and the banks themselves, that it is worth investing, that it is worth putting your money in the bank, because if there is a crisis, the government will give you back money. Sometimes it is more than that. The second issue is that in many instances, banks know that the bailout will come. And so in many instances, they have very, very risky behavior, which potentially makes it worse for the economy as a whole. This means that if you know that the government will invest because you're too big to fail, and they will have to save you no matter what, it means that you invest in corporations that aren't going to give you profits now, aren't going to give you profits in the next few years, but will potentially give you profits in a few years, if anything. But it also might be the case that you are investing in very, very risky mortgages that no one can buy and therefore destroys the economy. And I think what ends up happening in these instances is that the government has to spend a lot of money, which is a third issue, from federal reserves in trying to bail out. So the main thing that I'm going to note here is, oftentimes you do not have the capacity of backing up and saving these banks. Or if you do, it is incredibly, incredibly hard and expensive. And the thing that we would note on our side of the house is we prevent this from happening to begin with, because crises are less likely to happen, and your response capacity is better. Crises are less likely to happen First of all, because the government has more money to figure these things out. So if it is the case that you need to bail out, you just have more money from all the banks that are giving you money through the buying of bonds. Secondly, it means that you can develop infrastructure and things that are crucial for the economy to develop in the way that Max responds to in the POI. Because the response to the POI is incredibly dismissive. Max goes like, okay, well, sure, yeah, technically the government could use this for like helping the economy and stimulating. No, they will definitely fucking use the money to stimulate the economy. It looks like giving money to businesses. It looks like building roads that are important. It looks like creating an education system. It looks like creating hospitals that are necessary. The government doesn't just hold this money. It is billions of dollars that are actually used to invest in the economy. So to be very, very clear, opening opposition is correct. That one of the risks from the thing that we're doing is that you have less money to give to the average person that wants to open a restaurant. That you have less money to, for example, like just give to an average person so they can pay for university and whatnot. The trade-off is that you have more money as a government. And we think there are three advantages from this. The first is I think the government is a lot more interested in seeing like a healthy economy overall. The problem with banks right now is that they only lend where they are likely to get money back from, and that means that they subject a subset of the population to not ever getting money. It is true in many instances that you like lend to a part of the population, but 1 billion people in the world remain unbanked because in most instances banks don't see you as profitable enough. I think when you give more resources to the government who can build the infrastructure that is necessary, who can help for the types of businesses or just activate the economy in the areas which it thinks it is most important because it has information that the banks don't, I think it is way better. So just a very simple example, right? Biden gave money to individuals after the crisis, and he activated the economy and actually helped for growth to come back after COVID. On their side of the house, they would have had a lot more lending to individuals who might have not spent in the areas that the economy needed most. That is what you have to compare in this debate. And I think that in a good number of instances, just the government having more money is way better for the economy, and it is way better for preventing crises, because if a crisis happens, and at least you can respond in a better way.
Governments can raise money in two ways, bonds and tax revenues. Our side has higher growth. They raise more money from tax revenues to use on stimulus and checks. You raise money from 2.5% bonds. That's very little money.
Right. So the first thing I would note is the government is probably not our claim is that the government isn't raising enough money from bonds currently, because I think we only have like 1/5 of these investments from the banks in the bonds. I think when you have a lot more, like obviously it's 5%, but from a massive amount of bonds with significant investments over time. The other thing I would note is obviously people still invest in equity ones just because the interest rates might be lower in some instances. So that means like absolute worst case on our side, it means people aren't investing in the ways that opposition thinks are negative. In the best case, at least you see a marginal increase, which is better, right? So the whole thing that opposition says is, worst case, we don't have a massive impact. People still support equity accounts. That means we can co-opt their benefits in the majority of instances, but the marginal increase in these investments just gives more revenue to the government. And that I think is something we mechanized properly in PM that I don't think was properly responded in LO and that you can comfortably vote on. The other thing that I would note is that in response to closing opposition, obviously banks are a lot more risky in the status quo when they can afford to be risky. Because in the status quo, if you have a big pool of money deposited into the equity accounts, obviously you can invest in things that are not likely to give you money right now. And that also means that you do not signal the most confidence, or you do not signal such that you get the best confidence from investors, and you are not likely to just get money for the economy as quickly. I think on our side of the house, it means that you can no longer afford to be as risky because your pool of money is less, because you have to definitely make money back from the equity accounts. This means that the economy is way healthier because banks are behaving in a better way. They are no longer just investing and assuming that a bailout is going to happen, because the government is no longer going to bail them out as easily because it is already backed, but also crises are less likely to happen because, as we said, number one, the government has a legal duty to pay back for those bonds, but secondly, has a higher interest of like managing like more properly, because obviously like the bonds are bought by these corporations. The thing I want to note at the bottom of this speech is the following. I think it is definitely true that we have a decrease in lending by banks to a certain subset of the population. And I am willing to concede that in some instances, that means that economic growth is slower, even if you don't, especially if you don't buy my material about the government lending itself and like growing the economy. The thing that you then have to consider when you evaluate this case is the types of crises that you are avoiding. And considering that opening opposition does absolutely nothing to respond to the exogenous shocks that Sachin characterizes, because their only response is like, you know what prevents crisis? growth and investing in restaurants. Oftentimes, it just looks like an earthquake, a pandemic, an exogenous shock from a war that you couldn't have prevented. In those instances, we would have prevented this like crises from having a trickle-down effect, and we would have protected banks and the customers that depend on them. For those reasons, we're very proud to propose.
Thank you for that speech. We'll now call on the DLO.
Can you hear me?
Yes, loud and clear.
I'll talk about stability and then growth. On stability, their first argument is that this gives governments a much larger pool of money to utilize in their response. I want to flip this argument in 3 ways. 1, Max makes this argument, but let me make it again. During periods of financial crisis, if governments and central banks use the funding from government bonds to engage in stimulus, that gives them an excuse to not try to print money through methods like quantitative easing to engage in stimulus instead. What that means is, on our side, we have 2x the money spent on stimulus compared to Gov's side. Why? Because on their side, by investing in government bonds, you are not investing in company bonds, you're not lending to companies. That's the whole point of the narrow account. The money is not being lent to companies. So the private sector has much less money because this money is going to the government. Sure, the government spends it on stimulus, but it's still a redistribution of money from the private sector to the government. On our side, when the government needs stimulus, it feels the political pressure and central banks feel the pressure to lower interest rates, engage in quantitative easing, and print their own money to spend. But the private sector maintains its money, and the private sector is also spending during crisis, creating jobs and building infrastructure. That means during periods of crisis, we have 2 times the money being spent compared to proposition. So all the impacts Manuel names around building hospitals, building schools, cash transfers to people that is necessary to get the economy going exist more on our side. Now, God might say, why won't governments do this anyway? Why won't they just engage in quantitative easing if it's the better approach? But we argue, actually, governments are pretty reluctant to engage in measures like QE because it involves the central bank printing money. The central bank at the margin maybe risks losing some credibility. So if it has an outside option of money that the government has or the central bank has in the form of reserves at the central bank, you're spending less money. That's much less money being involved in stimulus. But second, we're just going to take a stance. Taking money away from the private sector is bad even during crisis. The private sector is better at spending money during crisis than governments for a number of structural reasons. 1, the private sector better allocates the money to businesses that are efficient. Governments are still likely to give it to businesses, not hospitals, because hospitals don't create jobs quickly, which is what you need during a crisis. Problem, governments aren't profit maximizing. They're not picking the businesses that are going to give them a return on investment. Often they're picking businesses that seem good, that seem like to employ a large amount of people. The private sector is giving it to profit maximizing businesses. This matters because it means the private sector is better at choosing businesses that don't fail and use the money well, because the private sector literally loses the money if the government loses money. Like, government isn't a profit maximizing entity. Voters bundle a bunch of different issues together when voting in elections. A crisis already looks really bad for the government.
Right.
This margin isn't going to be what pushes the government out of office. POI is exclusively in the chat. As a consequence, you're much more likely to have private businesses picking the places where the money goes better rather than burning the money by giving it to a business that cannot sustain during the crisis. Also, governments have things like nepotistic and political connections. For example, businesses that lobbied the governments by donating to their campaign finances for elections. This means they are more likely to favor those businesses, regardless of whether they are the best businesses to direct money to in times of crisis. So taking money away from the private sector, i.e. lending the private sector would have gotten towards stimulus, is a bad idea. But third, crises get worse because there is pressure on central banks to pay interest on excess reserves. What does that mean? You want the government bonds to pay meaningful returns, right? Government bonds usually pay low returns. You want them to pay meaningful returns because otherwise everyone will just put their money in the equity account, right? You want people not putting money in the equity account. So what central banks do is they pay IEOR, which is interest on excess, IOER, which is interest on excess reserves. They increase the interest on excess reserves, which in turn reduces consumers' incentives to spend money during crisis because they can put it in the safe, narrow account. That means consumers are spending less and crisis spending gets worse. This argument is totally flipped. Their second claim is they are pushed to make the riskiest investment to please their investors. When banks have less money to make risky investments, they are forced to choose safer investments. I want to flip this argument again. One, lots of this money will still be in equity accounts because equity accounts just give customers higher returns. So a lot of people will favor equity accounts over narrow accounts, although obviously many people will put their money in narrow accounts as well. Here's the problem. Even if there's less money being lent out, equity accounts are far riskier than bank accounts are in the status quo. The type of lending they engage in, the type of businesses they invest in are likely to be substantially riskier, even if there's less total money that banks have access to. Couple reasons. One, it's harder to justify regulating an equity account because you can just say, oh, customers have this other low risk option. We are expanding choice. So governments don't have the same political incentives to engage in regulation. But second, when fewer people put their money in equity accounts, banks want to compensate for this loss of profits. So they invest in higher risk assets that are much higher yield because high yield correlates with higher risk. Their response, there's moral hazard. When banks know deposit insurance or a bailout only applies to the to bank accounts in general, that makes them engage in more risk. That's Manuel's response. Actually, bailouts don't cause banks to engage in that much more risk. Why? Because even a bank failing, even if it gets a bailout, is terrible for the bank. One, a bailout is literally a loan. The bank has to pay it back. Two, bank failure leads to people making the decisions like executives being fired, looking really bad. Three, no bank has a guarantee of a bailout. The 2008 crisis happened because the Fed let Lehman Brothers fail. No bank will take that risk. Before I move further, closing a POI.
Can you force the Treasury to issue a bond if they don't want to?
I mean, well, who's you? Like the government is you. The government can force the Treasury. I'm very confused by this. Okay. The second reason this worsens stability, by the way, is it increases shadow banks and other worse financial investments. Why? Because if expected returns from investing in a bank go down, if the equity account feels like it doesn't have a ton of capital flowing around in it, a lot of people realize rather than putting their money in a bank, they can gamble their money on the stock market. They can rely on firms like private equity firms. And companies realize they get less money off commercial lending, so they start relying on these less regulated financial firms instead. Problem, these are institutional investors that are more okay with losing their money, and they operate on shorter time horizons because they are not managing things like people's retirement. But ultimately, Manuel concedes the total amount of lending goes down. Here's the problem. Much less capital is a huge impact. Low-income people not getting loans is larger than the impact of stability for a couple reasons. One, because crises are rarer. If crises are due to exogenous shocks like an earthquake or a pandemic, they are literally rarer than year-on-year growth, than businesses getting investment every year and creating jobs through that investment rather than a government holding out for when a crisis happens. Second, even if a financial crash happens, deposit insurance means people aren't that hurt because they get money back. People are really hurt when economies don't grow because they are stuck in poverty, stuck without jobs, stuck without governments having money to fund day-to-day welfare systems. This is a massive impact that outweighs the impact of stability, even if you accept their claims on stability. Oppose.
Thank you for that speech. We'll now call on the member for the government.
Hey, just making sure everyone can hear me.
Yes, loud and clear.
Awesome. POIs in the chat, please. Thank you. Opening opposition are correct. Crises are few and far between. But what is not few and far between are the day-to-day neglect that occurs to municipalities that are currently underserved by government. Is the creeping predation of banks on their consumers when they continue to not offer them products because they have no fundamental competition to the structure of accounts that many people are forced to use. Closing government operates in perhaps a more boring version of the world than opening government because honestly those crises are few and far between. But we do two fundamentally important things to this debate. First, we're going to explain why this increases demand for a wider variety of government assets than just treasury bonds, and why that then improves policymaking and the availability of economic growth in many parts of countries and the world. Secondly, we're going to explain why this improves the quality of services that are offered by banks. Let's firstly explain why this increases demand for government assets. There are a couple of premises that are important here. The first is that obviously the substantial numbers of people will choose to not opt out of the narrow accounts. I think that a sizable number probably still do choose to use equity accounts, but there's clearly, in order for any of, say, opening up positions harms to even work, that a large number of people have to opt to stay with narrow accounts. So that massively increases the demand for government-backed assets, probably treasury bonds in the first instance, because they're federalized, they're popular, and they're extremely visible. But second, that there is a finite amount of treasury bonds and those types of government-backed assets that are available because governments use these as policy tools, which is the point of that POI, right? Like, if the harm here is that opening opposition describes is, well, the treasury overissues too many bonds in response to this policy and therefore can't do kind of the crisis management stuff that it would ordinarily be able to do if it waited to issue those bonds. If the treasury doesn't want to issue any more bonds, they don't have to, right? Like, they have control over that asset. So the third thing to explain here is that there are other types of government-backed products in like products and investment services in a wide variety of contexts. There are firstly things like municipal bonds that are issued through state, local, and municipal governments for tailored local projects, as opposed to general government policy making that opening government talks about. That is literally a local government needs a new hospital that won't be very profitable because this area is underserved in the healthcare that it requires, but needs the money in order to break ground. Secondly, looks like government agency securities, like farming securities, like rural utility services securities, like public housing authority securities, all of which are debentures that you can collect profits on when they come to fruition. What this then does is drives people and drives banks to that set of products as well as the existing types of ways that people invest in government-backed assets like treasury bonds that are highly visible. This is really important because nobody can force the treasury to issue a bond, but the government can now force banks to acquire government-backed assets. So this forces investors to look at the full plurality of government-backed assets that are actually available and are really underutilized in the status quo because they're in a locally specific area, because people often don't know that they're available or that they exist, and like they can't immediately see the problem that is posed by them. And it encourages those local governments, those municipal governments, those government agencies that do specific things like public housing to issue those bonds as investment products more readily. That allows people to enact incredibly important policy changes that allow for greater economic growth, if that is what opening opposition is concerned about. That is what gets infrastructures and highways fixed across the United States in areas that are severely underdeveloped because of their population size or because of their electoral unimportance, all things that are incredibly arbitrary. Now we get far more money into those agencies. This is really significant because we don't require that a federal top-down government has an incredibly concrete policy plan to execute all of these things. We just let the market do its work. So if you think that markets in terms of buying these investment products are efficient and allocating those resources, then you allow them to be efficient in this respect as well, and we drive investment into all of those areas. That is an incredibly good thing for the debate. It is an untold economic benefit to all of those areas, and it's totally unprecedented, and closing government is able to claim it. That looks like rural areas having more public housing. It looks like them having more hospitals. It looks like them having roads that work and are fixed so that you can transport products, that you can engage in economic growth and fix the crumbling infrastructure that plagues many states, plagues many areas. I'm going to secondly explain why this improves the services that are offered by banks, but first, opening.
This extension gets the debate wrong. It can't be any government-backed asset because if the asset has effectively no returns, municipal governments don't have AAA ratings, and it is
so here's the thing: it is government-backed, and they are government-backed assets, and they do have returns. In fact, I explained in the speech why they have returns. For instance, things like a hospital that makes profit because you charge people for healthcare services does have a return. Things like agricultural bonds do have returns because you sell agricultural products. Things like rural utility services, when you pay for a project that sets up lines that allow you to distribute internet and telecommunication services that people then pay money for, but they previously couldn't because they didn't have the equity to break ground on this. I just took your POI data. Go away. All right, let's secondly explain why this improves the services that are offered by banks. This is a very simple observation. Banks like money, and they can make money from these equity accounts, so they want you to use equity accounts, and the ways that they will encourage you to use those equity accounts are not just the kind of crude instrument that opening opposition says, where they're like, oh well, they'll just like predatorily offer you greater interest rates. The first thing to say is like, yeah, maybe they do give you more interest. It's unclear why the only way that they would do this is by engaging in much riskier investments, especially if financial sectors are as well regulated as the opening half of this debate seems to suggest. And given that banks are enormously profitable, especially retail banks in parts of the OECD countries, I know Australia has like the most profitable banks in the world, you just take a lower cut of the profits that you make off of those investments, hand more of it back to consumers, which seems like an enormous win. Second is that they can reform their risk profiles significantly because there is a huge signaling effect of the risk to consumers at the moment that governments step in and say that no, the default should be narrow banking and narrow accounting. So you have an disproportionate incentive to appropriately explain to people the risk profile, how you have dramatically reduced your risk profile for the everyday equity accounts that people would be putting their money in, which means that you engage in far more consumer-facing communication where people otherwise didn't appropriately appreciate what was going on with their money. So you need to assure them that you are in fact making reasonable investments. That is really good for banking regulation. Is really good for the way that consumers make decisions. The second thing that you can do is you can explicitly target different risk profiles through different types of equity accounts. So, for instance, sort of like the way that superannuation or retirement accounts are done, and tailor everyday savings accounts to different levels of risk, which gives people better control. The third thing you can do is create specialized accounts to encourage people to put their money in for particular interests. For instance, saying that, okay, this is an account that you can take out and we will lend out the money to assist in the green transition, or we will only lend out money to, say, companies that are based in this country. So aside from appealing to people's economic rationality, appealing to what they really value in life as well. Those are I think the opening half of this debate is woefully uncreative in the way that they think banks will respond to this. If it is the case that there is an enormous incentive for banks to keep your money in equity accounts, they can do it in a series of ways that are really good. Everyone has to have a bank of some sort, and it is incredibly bad to be unbanked in many instances, but banks have a monopoly unduly over the way that those accounts work because they do not have sufficient competition to their very business model. This is a debate that adds that competition in ways that are good for policy and that are good for banking. Incredibly proud to govern.
Thank you for that speech. We'll now call on the member for the opposition.
Hi, can I quickly check if I am audible and visible?
Yes to both.
Perfect. Give me a sec. I prefer POIs verbally, so please feel free to just unmute yourselves and ask. Give me a sec. I think one of the things that's been missed in this debate is that it's not that banks only raise capital or profit through, deposits or loans that they're giving people or investments. One of the key ways in which banks like JP Morgan, et cetera, or any other bank really raises money is also because their stocks are traded on the stock market. So I want to, first of all, in terms of framing, just give you a sense of what the capital crunch actually looks like. The capital crunch isn't really just people not investing enough money into banks or banks having less money to invest into other things. It is also that all of the revenues that banks were generating because of the stock market just disappear because they're no longer investments that will lead to high yields or high returns. People don't expect banks to do particularly well or raise a lot of money or make a lot of profit anymore. And that means that lots of banks have a lot less money now. I want to make it also clear what this world looks like, where banks are now under a capital crunch for various reasons. Their profit margins are lower, but they're also not getting investments through stocks. They will most likely be cutting jobs and cutting the expansion that they have. They won't have the money to expand, not only in terms of geography, but also expand in terms of financial products. And I'll make that clear in terms of extension and why that will be important. One response, and I guess in terms of response, I'll just start off with risk management, which is going to be the first bit in terms of our extension. And this nicely also responds to everything that I think most of the stuff that CG comes up with. Now, CG asserts that banks suddenly become a lot better at managing risk. I would say that they become a lot shit at managing risk. There are a couple of reasons for why this is true. The first thing to note is that risk management is likely to be one of the first departments where you cut money because one, there is less money, as I already proved, available to you. You don't have the capital. But two, it's the easiest way to save money because the overall opinion of the market is that government bonds are very stable. So why would you beef up your risk monitoring and risk teams or corporate governance teams if you expect all of these investments to have returns that are stable? That's one of the first areas where you cut money away from, which is a problem. The second problem is with the moral hazard that I just mentioned, which is you expect this to do well, therefore you do not have a reason to be as risk averse as CG claims it. Why is this such a big problem? If these are low risk investments, I would also note that while government bonds are technically recognized as very safe investments, they also suffer from investor confidence issues as well. I.e., you don't really necessarily need to only be Argentina or Pakistan where people are discussing, oh, will the government default on its payment to the IMF or the World Bank? Now, should I really invest in the government bond? Will the government default? That's the worst case scenario. But I would note that that faith in governments and their economic performance also fluctuates, i.e., if COVID comes up in the horizon, or the war in Russia starts, or lots of crises that most countries will cyclically go through, but also very frequently come through, the first response for a lot of people with their money in bank accounts, specifically bank accounts which are safer now, is likely going to be to withdraw that money as soon as that sort of eventuality happens. Note panel, this does not need to be a full-fledged economic disaster for people to start withdrawing their money. All they need to do is have a shred of doubt that the government is not going to be able to do well or handle this effectively. If this instrument was there for the financial crisis that emerged out of COVID, I would reckon that most banks would get fucked. And the reason for that is very simple. If people start withdrawing their money, this is how bank runs happen. So if anything, what you've made disasters which weren't that big, economic disasters which weren't going to be that influential on the economy and the future of the country, probably become a lot better, a lot bigger, and a lot more harmful because people start withdrawing their cash from these bank accounts and keeping the cash for themselves. I will take OG.
But we give you an account on why bank runs are less likely to happen. As an average individual, you know that there is a higher backing of your money just because the government has a responsibility and you have a lot more capital to save them in case this occurs. So
yes,
people invest in banks
except
a lot more.
what you don't really say is lots of people around the world don't have faith in governments. Like, yes, you may objectively know that, oh, the government bond's going to come back at some point, but lots of people don't have trust in their governments. But secondly, I'll also say financial literacy isn't really the best thing that governments are able to teach people in public education anyway. So I would point out that bank runs are a lot more likely on your side of the house. Panel, the reason why this is important is because you are now exposing the economy to not only systemic risk, but as opening half keeps on saying, oh, systemic risk is something that, you know, economic recessions happen cyclically, but they're not that frequent. You're making these a lot more likely and a lot more frequent. So in terms of impact, this is a lot bigger than people expect. The second thing I want to talk about is also in direct clash with what CG says around, oh, banks are going to, you know, make different accounts for different people. They're going to educate consumers and so on and so forth. Remember, banks don't have the kind of money that we're talking about. This is not the status quo where banks are having insane profits. I would know that there's a couple of reasons why this is terrible. I want you to just, in terms of framing, think about why banking as an industry has become so big. Banking was not this big in the 1910s. Banking was not this big in the 1920s. From the 1960s onwards, banks became big. The reason why banks became big and economies got a lot of cash to grow very, very quickly and super well was because of innovations such as mortgages, which banks introduced, derivatives, credit cards, online banking, microfinance, ETFs. All of these are things or new products, financial products that banks have made. What do these products allow people to do? One, invest more into the economy, invest more frequently into the economy, and invest more money into the economy. I think overall, this means that there was a situation where through these innovations, we created the context for businesses to become a lot more successful and grow a lot more, and a lot more innovation to come through within our economies as well. The economy would not have looked the same way had banks not had access to like credit cards or derivatives, or all those things might not have been there. Because of this capital crunch, the one thing that you affect the most is banks' ability to innovate in terms of financial products. Because again, note panel that they are cash strapped, that they are now, according to everyone, risk averse as well. They want to keep the money that they have. So they're unlikely going to have incentives to invest into these kinds of products, not only sell these kinds of products, but also, given that they are going to be risky, not going to make these kinds of products for you. The impact of this is big because it's not just the current economy that you're sort of fucking up in terms of systemic risk. What we're trying to say is holistically, overall, future economies are super fucked because these banks do not have the financial products or are not offering the financial products that these companies and people need to grow. The last thing I would note, just in terms of innovation as well, is if everything that side government is saying is true, then banks are also unlikely to start giving money to startups, etc., which are, I guess, more risky investments because there's no guaranteed return on investment. This is extremely bad for the economy because the most tech innovative and financially innovative companies out there will not have access to the finance that they need to succeed and for economies to overall grow. For all these reasons, very proud to oppose.
Thank you for that speech. We'll now call on the Gov Whip.
Hello. Can people hear me?
Yes, loud and clear.
That's awesome. Points of information just in the chat, please. Closing government make two quite elegant observations, which quite easily win us the debate. The first is that the government issues a whole lot of bonds, and some of these bonds are things for local governments or state governments who otherwise struggle to raise money. And when we ensure that banks can provide a source of money to these governments, it means things like roads and hospitals can in fact get built, and they can in fact get a steady stream of returns from that because these are things that make money. We second of all observe that when there is a capital crunch, as opposition wants to put it, banks kind of have to hustle to get people to put money in equity accounts again. And what that doesn't look like is just like pulling the wool over people's eyes and making them not aware what risk is. It's doing things like offering a spectrum of risk for people to access and providing them a bunch of different products that they can buy. This is a huge benefit because it means people have more agency with their money, and it means money can be allocated in more socially utile ways. So first, let's defend our extensions from any attacks that were leveled against them. Then I'm going to do direct response to each individual team. First of all, on direct kind of defense of our extensions. The first one about the quality of economic products from banks, I think it's quite a half-hearted response from closing government, because their literal response to this is that banks, when they have less money, are going to fire everyone in their risk departments, and this means these products will be worse. First, on the face of it, this is a crime in every jurisdiction. There are a series of restrictions that banks do, in fact, have to adhere to when it comes to risk, so it's unclear that things can get as draconian as our closing opposition say. But second of all, this misses the claim as we put it, because it's not to make things mega risky or mega unrisky, it is just to provide consumers more options in where they spend their money, whether this be on different risk profiles, or whether this be on different initiatives. And the impact of this extension is monumental. It gives people agency with their money, which they work quite hard for, and it ensures that money goes to places where people view it as being useful, as opposed to wherever like a tech startup would need it or something, which seems to be the claim from closing opposition. What this means is that money is distributed to people who need it more. That is a clear and consistent win from closing government. Our second extension does not get an attack, which is about how you get access to government funding from other services. The best attack at this is the POI about how these things don't make money. We dealt with this quite easily because these things do make money. This explains that both of our extensions should stand, and given that these extensions operate outside of crises and outside of special circumstance, they should just be weighed as the most highly in the debate. Let's then respond to every other team in this debate. First, let's deal with closing government. The main claim here is twofold. The first is this leads to capital flight and bank runs because people get really suspicious of governments. First, you've got to use the word comparative in that speech, because if people are afraid of governments, oh boy, they're going to be afraid of businesses. If they view the institution, the prince or the money as teetering on the edge of going under, they will also view all of the various shops and firms as also being about to collapse. So they'll withdraw their money from these equity accounts anyways, given that governments, even if you're financially illiterate, are larger, means that people are far less likely to pull their money out of these accounts. What this means is the government is generally seen to be fine and we don't in fact get these bank runs. The next thing is about startups, and I don't actually think this stands because one, the best and most promising startups will always be good investments, and so people will put their money into them anyways. And yeah, that just means that harm doesn't really eventuate in the debate. The actual startups we lose are just the weird ones that are just throwing money in a fan and hoping something actually comes of it. That explains that closing opposition are actually locked out of this debate. Let's then bite into the clash on the opening half and deal with OO explicitly. The first thing I'm going to do is respond to the claim about how this crowds out private investment because there's a lack of credit, and that is very bad. The first thing I'm going to do, and the way I'm going to beat this opening half, is by explaining why exactly banks are worse than governments at allocating money, devoid on the stuff about the amount of money they have access to. A few reasons for this, and notice this is kind of leaning on our extension about the specific funding initiatives. First of all, profit-seeking behavior from banks, which opening opposition rely on for their mechanism to work, does not in fact produce socially utile results, because what this means is that money is given to the most profit-efficient businesses, not the most socially utile businesses. So the trade-off in this debate is just giving every dollar to like a private equity firm or to Apple or something, versus actually giving money to local governments that need it to do things like develop infrastructure and create a safe and happy environment for their citizens. But second of all, even if that isn't the case, we do prefer if money can be taken from governments in this banking way as opposed to tax that they propose, because this is at least providing people more agency in how much and where their money gets spent. The second response to this is explaining that less credit is actually better for the economy, because a bunch of the way loans are spent on the economy isn't through things like students getting an education, it is through speculators and investors betting on the economy, taking out loans and then putting it into the stock market and hoping line go up. And what this means is that when there's any volatility or variation in that line, that is like economic growth, it is significantly amplified because a bunch of people have taken out loans hoping that they get a return on it. So what this means is that when you reduce the access to capital, these are the people that leave the market first, because now their risk is slightly higher, and this means they don't want to engage in this kind of thing. This means that things like student loans do still exist. But third of all, when businesses get money, they actually operate pro-cyclically, which is really bad for the environment of the economy, because when the economy is growing, businesses take a bunch of capital and spend it to expand, which is really inflationary, which causes things to get more expensive. And when the economy is going poorly, they save all of their money because they're afraid they might go under, and this means it's quite contractionary and you don't actually get economic benefits. When governments do this, they don't actually have to worry about turning a profit, which does just result in the fact that, you know, they just can smooth out the economy, which is why we prefer the government having this money. Finally, we do just explain to you that there is just a bunch of other things the government can spend this on. It's smaller, more certain, and micro-level initiatives. That should beat 0-0 and win over the opening half clash. I'll take a point from closing opposition.
Yeah, I don't get why the comparison is between private markets and governments, whereas if a company fails, people are not going to withdraw their money from a bank. But because you've centralized risk, if a government is expected to fail, people have an additional incentive to remove that cash.
Okay, so your mechanism is when the entire economy is under stress, people are fine because maybe one business might fail. But the issue is every business fails when the entire economy is under stress, which is why this comparative exists. Let's then trounce OG. Their claim is that volatility is bad, and this means it's good when the government has more money. But I think our context here about smaller and local governments is far more persuasive, because the Treasury doesn't normally have an issue with getting people to buy its bonds, because it is like the Treasury, it is like the money thing. And this means our context of local governments or state governments is far more persuasive. So giving money to those agents is actually the more important thing in this debate. But second of all, given all of the response I just did to OO, explaining why these are actually, why money is actually better directed by governments as opposed to just why having more money is good, should additionally weigh us over them, because it answers the question from OO that they simply couldn't answer in their speeches. As a result of that, we produce more things that are good for society, we give people agency and their money, and we ensure that financial products do just in fact get better. These are quite certain and quite good benefits in the debate, and I am proud to close the government side.
Thank you for that speech. We'll now call on the opposition with.
Just checking that I'm audible.
Loud and clear.
Wonderful. Starting momentarily. As a humanities student, I can confidently assert that this debate is my worst nightmare, so forgive me if I get any of the words wrong when I'm doing any of this dense financial analysis. I'm going to be talking to you about three things in this speech. First of all, our extension and systemic risk and why the attacks on it don't hold. Secondly, why it's better for private actors to have money as opposed to the government, whether within or without crisis. And thirdly, why our analysis on growth uniquely defeats OO and captures all of their benefits. So on to the first one, systemic risk. And this is where the claim we made was very simple. You have now basically married private and state confidence in a way which is going to cause the entirety of your private and state sectors to collapse the moment that the state sector has any sort of lack of faith in it. We heard a couple of responses. First of all, people trust governments. Untrue in the vast majority of the world, and increasingly untrue even in places where it's typically held true. So I think that government faith and faith in governments has been going down pretty steadily across the developed world for the past 15 to 20 years and has already been pretty low across the rest of the world. So I don't think it's necessarily true that people trust governments. Therefore, the mechanism for analysis still holds here, which is that whenever there is a greater bump in loss of faith in the government, people are likely to go withdraw their money from the banks because they're aware that their money is hinged on government-backed securities, which is going to cause not just the government source of financing to dry up, but also your private sector source of financing to dry up, doubling the harm while providing no meaningful benefit. The response we heard was, well, private markets also collapse sometimes, right? And people would have withdrawn money in any case. This was their claim to being comparative. Our response, yes, but private markets are spread out and diversified. So even if segments of them collapse, that doesn't mean people are going to withdraw all of their money from all of their investments because they're diverse. worse, and there's no need to manage that. The other claim we made here regarding systemic risk was that banks are less likely to monitor their own risk profiles carefully in the event that they're putting all of their money into government-backed securities because they think, well, this is stable, we can do what we want. This introduces a moral hazard. The response we get from closing government, I'm very sad to say, is basically that's illegal. Yes, it may be illegal, but that doesn't mean that banks are not going to fall into the exact same pattern of incentives we've identified over here, therefore increasing the risk of systemic risk within the economy. I think then clearly systemic risk is a real and meaningful concern, and you've increased the chances of crisis and bank runs within closing opposition uniquely. The second thing then, why it's better for private actors and the private economy to have money than the government, several things to note over here. First of all, I want to respond to closing government's claims over here, which is that, well, we're going to give you a whole bunch of types of bonds. You'll have municipal bonds, federal bonds, treasury bonds, everything. And this is going to be used in a really effective spread out way and will be socially utile. A few responses. First of all, they've sort of tried to pretend that there are market forces governing how these bonds are, how the loans issued off of this financing is going to be used because they were able to use the word municipality. I don't think it's true that market forces are governing anything. I think municipal forces are, which means that nepotism, personal interest, municipal politics, and the like are all likely to be very relevant in how this money is accorded. They then try to defend over here by claiming, well, you know, it is better for these socially utile decision makers rather than market forces to be making their decisions. I think in this, they haven't been responsive to OO's initial analysis, which is that private sector and investments are likely to maximize growth by virtue of being profit motivated. And growth, once it expands, has effects for everybody in the economy because it's better to have a bigger pie than it is to distribute more equitable pieces of a smaller pie. And in your case, your pie becomes very small because we've all agreed there's a capital crunch inside the economy. So I don't think it's really useful for them to make the claim about socially utile outcomes when they haven't actually managed to prove that there's enough money to achieve meaningful socially utile outcomes. Onto the private actors and government thing, though. Private actors are better for a variety of reasons. They have an innovation, profit motive. They're likely to lead to optimization, blah, blah, blah. They're likely to actually diversify and expand different types of industries and things that governments are unable to do, whether because they're less responsive to market forces or whether because they lack the know-how. They are likelier to actually try to innovate and produce new things. I'll weigh this against OO a little bit later as well. But basically, private actors grow the economy. But more than that, they're also better at handling crises for more reasons than OO has given you so far. First of all, in the event that the government has not eaten up all of the money inside the private sector, capital markets are likely to have more money in the event that a crisis happens, meaning that they can fix the liquidity crises which might emerge at any given point in time by giving loans and similar things to different companies and actors inside this debate. If private actors have a good amount of money, they're likely to be able to employ and hold on to people's jobs during crises, which means people can continue consuming and spending and saving the economy. And furthermore, because private actors are more likely to be integral to global supply chains by virtue of the fact that MNCs and the like are all private actors, it's very possible that by making sure that they are robust during times of crisis, you're able to prevent crises from going global, which are all reasons then to believe that it's better for private actors to have money than governments during or outside of crises. The final issue then on why we're going to be able to outcompete OO on their growth point. Before I do that, I will take opening if they have one.
To no compelling response from opposition bench, we explained that the common crises are prevented or dealt with better when the government has billions more in revenue, there is more confidence in the government, and also banks are less risky because they cannot risk the few money they have. It doesn't make sense that if you have less money, you use it in the riskiest way, because if you lose that, you lose everything. So it doesn't make sense in this regard.
I think we've already given several responses to this. The major one is that crises can't be the only metric by which you judge this debate because they are fair and far few in between. But also, I've just given you reasons to believe over here that private actors can handle crises better than governments when they have cash as well. So I'm not really sure that I care so much about governments having massive amounts of liquidity. Final issue then on how we're going to beat OO on growth and everything. Their major claim here is largely about credit, the availability of capital in the market, and why that's so important. Very fair. They've met for you why growth is so important and why it uniquely improves everybody's lives, even when no crisis is active. We have given you the biggest single motor of growth present within the debate in our extension speech, namely innovation of financial products. When banks are strapped for capital, they have less investment into the innovation of financial products, consequently not producing any new ones. Why is this important? Because the major source of growth in human history for the past 50 to 60 years is financial products. What a financial product basically represents is a multiplier effect for whatever money is in the economy. $1 by virtue of different products and different derivatives and lending services going on, is magnified to have the effect of $100, $150, increasingly spiraling and becoming a greater source of financing throughout the economy. This produces a source of growth which is unmatched by anything discussed by any team in this debate so far, meaning we are uniquely able to provide this sort of growth and then harness all of the benefits of growth growth that opening opposition has then proven for us over here. But we've also proven to you why the capital on the crunch side, capital crunches are also produced because banks are no longer able to use their other source of financing, namely stock market revenues by trading stocks over there. They don't have the money for this anymore, so they're unable to gain revenues and the money which comes as a consequence of that. But even when it comes to opening opposition's argument on the developing world and how banking fees are going to cause people to become unbanked, I think they left the important impact there, because the harm of being unbanked, crucially, is that everybody in the developing world then holds onto their own cash. What this means then is that there is a greater and greater amount of cash present within the entirety of the economy, chasing the same static amount of products, meaning that prices also raise inside these developing countries, which are likely already host to a series of economic harms, meaning that already poor people inside these countries not only don't get savings, but have to use their existing cash to buy even more expensive products. On the whole, the reason we win this debate is because this does introduce systemic risk, because private actors, whether in or outside of crisis, make better economic decisions than the government, and because we uniquely prove to you how we access massive growth through financial product innovation. On all of those grounds, exceedingly proud to oppose.
Thank you for that speech. And thank you very much, everyone, for the wonderful debate. Results will be announced in the main room. Speakers, please excuse us so that we deliberate. All the best.
Thanks, everyone.